Hello and welcome. If you are a non-resident Indian looking to invest in the Indian stock market but are not sure which funds to invest in, then in this video I'll tell you which Indian funds are the best for long term and explain the reasons why you should invest in them. My suggestions will be backed by a research study conducted by S&P Global that examined the long-term performance of funds in India. My name is Kanak and welcome back to my channel. For more content from the world of investing, finance and economics, subscribe to my channel. Alright. Let us start by understanding the two key types of funds available to investors in the Indian stock market. The first type is actively managed mutual funds. In these funds, a fund manager decides which stocks to buy and sell, when to buy them and how much to buy. Essentially, in an actively managed mutual fund, the fund manager makes all the investment decisions. On the other hand, there are index funds that simply track an index, such as the Nifty 50 index in India. There is no fund manager deciding which stocks to buy or how much to allocate to those stocks. The Nifty 50 is a large cap index that represents the 50 largest companies listed on the Indian Stock Exchange. This is a market cap weighted index, which means larger companies have a larger share in the index. Now let us look at the findings of the study by S&P Global. According to the SPIVA research study by S&P Global, index funds outperformed actively managed mutual funds over long term in India. As you can see on the screen, the table shows the percentage of mutual funds that underperformed the index funds. The x-axis of this table indicates the type of fund, large cap, mid cap, small cap or bond funds. And the y-axis shows the time period, which can range from 1 year to 10 years. The percentage in this table tells us what proportion of mutual funds failed to generate more returns than the index fund. As you can see, over a period of 5 or 10 years, most actively managed mutual funds underperformed the index funds. Across all categories of funds, that is large cap, mid cap and small cap, the mutual funds have underperformed the index funds most of the time. So, if you're a long-term investor looking to invest for 10 years or more, you are more likely to generate higher returns by simply investing in index funds in India instead of trying to pick mutual funds. Now, you might think you have the ability to spot the mutual fund that will beat the index funds, but it is not an easy task to predict which mutual fund will outperform the index funds. This is because over a period of 10 years or more, only 1 out of 10 mutual funds beats the index fund. So the odds are stacked against you. This is also true for the US stock market, where most actively managed mutual funds fail to generate higher returns than the index funds over long periods, such as 10 or 20 years. Now that we know that index funds in India perform better than actively managed mutual funds, the next question is which index funds you should invest in. Index funds can vary based on factors such as size, which includes large cap, mid cap and small cap index funds, or other factors such as value index funds that invest in value stocks, growth index funds that invest in high growth stocks, and dividend index funds that invest in dividend paying companies, and other factors such as momentum or volatility. It is usually advisable to keep a very simple investing strategy where you invest in the broad market by spreading your investment across large cap, mid cap and small cap index funds, rather than chasing various factor based indexes such as value, growth, dividend, momentum and so on. The reason I do not recommend investing in various factor-based index funds is because of the cyclicality in their performance. There are times when these factors do well, but there are also times when they underperform. It is nearly impossible to predict which factor will outperform and when it will outperform the market. So instead, you should simply invest in the total market by spreading your investment across large cap, mid cap and small cap index funds. Now the next question is, how much should you allocate to large cap, mid cap and small cap index funds? Before we talk about the allocation across these index funds, let us understand the return and risk profiles of large cap, mid cap and small cap indexes in India. Over the last 5 years, from 2019 to 2024, the Nifty 50 index delivered a compounded rate of return of about 19%, going from 11,000 points in 2019 to 24,000 points in 2024, which is almost 2.4 times. The Nifty 150 mid cap index delivered a 30% return, increasing from 5,700 points in 2019 to 21,000 points in 2024, which is almost 4 times. Finally, the Nifty Small Cap 250 Index delivered a 36% rate of return, rising from 4,700 points in 2019 to 17,600 points in 2024. As you can see, the Small Cap Index has delivered more returns than the Mid Cap Index, and the Mid Cap Index has delivered more returns than the Large Cap Index. However, I want to caution you on 3 very important points. Firstly, even though returns are inversely correlated to the size, it is important to note that risk is directly proportional to the size. This means mid-cap indexes are more volatile than large-cap indexes, and small-cap indexes are more volatile than mid-cap indexes. Especially when the market goes down, they tend to decline more than the large cap indexes. Secondly, the last 5 years have been abnormally good for the Indian stock market. You should not base your future returns expectation solely on the last 5 years because past returns are not guaranteed predictor of future returns. Thirdly, over the very long period since the launch of the Indian stock market back in the 1980s, large cap stocks in India have delivered around 14 to 15% rate of return. So you should be cautiously optimistic in your assumptions about future returns. Now the final question. How much should you allocate to Nifty 50 large cap index, Nifty mid cap 150 index and Nifty small cap 250 index funds? The answer depends on your risk tolerance, financial goals and investment time horizon. If you are a long-term passive investor looking to invest for the next 10 to 20 years, you might consider allocating anywhere from 50 to 70% to Nifty 50 large cap index funds, 30 to 40% to Nifty 150 mid cap index funds, and the remaining 10 to 20% to Nifty 250 small cap index funds. This allocation will provide stability as well as good long-term returns to your portfolio. Now, there are various asset management companies that offer all three index funds, and you should choose the index funds with the lowest expense ratio. Since the returns for these index funds will be more or less similar, the primary difference will be in terms of fees, which is your cost of investing. If you are getting almost the same returns over the long period, you will want to minimize your expense ratio. Thanks for watching till the end, and if you like this video, hit the like button and subscribe.